All right, welcome today to Investing 102 Risks and Rewards. This is our second investing oriented webinar of February. This is the last one we're going to do for this academic year, but we have plenty of other ones recorded that you can check out if you are still thirsty for knowledge after participating in today's webinar. My name is Andrea Pellegrini, and I run the Student Money Management Center out of University Bursar for the entire University of Illinois system. So that includes Urbana, Chicago, and Springfield campuses. And I'm joined today by my colleague, Anne. So, Anne, do you want to introduce yourself and then go through our disclaimer?
Sure. So my name is Anne McKinley. I'm an assistant director in the Division of Enforcement in the Chicago office of the U.S. Securities and Exchange Commission. And I've been with the SEC for quite some time. And just by way of disclaimer, we are not providing any legal or investment advice today. Instead, we're just discussing general principles of sound investing and avoiding fraud. We at the SEC are partnering with the Get Savvy team on these investing presentations, but we aren't responsible for any of the other presentations or their content. Today, I am speaking in my official capacity as an attorney with the Division of Enforcement of the SEC, but my remarks don't necessarily reflect those of the commission, any of the individual commissioners, or anyone else on the SEC staff.
Thank you so much, Anne. And I really want to emphasize that we are going to be educational in what we're providing today. So we can answer some questions, but there may be questions that are too much along the lines of advice for us to answer. All right, so I'm going to launch a demographics poll to get an idea of who's joining us today. You don't have to participate if you don't want to, but it does help us get an idea of who's kind of here and participating in the webinar. If you can let us know kind of your age range, whether you're a student or an employee. There's lots of things that we may be talking about today that we will cater to our audience based on who attends. So thank you for those of you that are able to participate. It looks like about 26 of you, 36% of you. Oh, this is going way up. Thank you for participating. So we have lots of people across age ranges from 18 to 74 joining us today, which is great. We have lots of students, but more full-time employees. You may be both a student and a full-time employee. I am. We have lots of women on today as well, and good distribution for race and ethnicity. So thank you so much for participating. Again, you don't have to if you don't want to. I'm going to go ahead and end the poll and just share the results real quickly so you can see who all is in the virtual room with us. All right, I'm going to stop sharing. If that box is still up, the poll, you can just exit out of it. All right, so just to go over our learning objectives for today, we want you to understand the risks involved with investing since there are so many of them. We also want to help you identify investment strategies to mitigate risk. And we're going to describe ways that fraud can derail some of the rewards of investing. That is the whole point of starting with your investing journey. All right, so we're going to do a Padlet activity. If I can get it up. All right, so Richard, can you share the link to the Padlet activity in the chat? So if you've never used Padlet, it is an anonymous tool that you can use to facilitate kind of brainstorming. We would like you to participate in this one. All right, thank you, Richard. So what I want you to do is to go into this little plus button in the bottom right-hand corner of the Padlet screen, and you can put a subject, you can write something specific about whether a risk or reward of investing is something that you're thinking about. You can also use GIFs or even share a link if that's inspiring to you, and either put it in the risk or reward section. So let's say I'm going to look for this is kind of what I think of. I don't know why approval is required. So while people are participating in that, if you're having trouble using it, just let me know in the chat in Zoom, and I'll see if I can troubleshoot while people are participating in this. We really want to kind of do a risk benefit analysis of investing by crowdsourcing it from you all today. I guess I should have tested this Padlet. I tested everything else today. All right, so if Padlet's not working for you, if you want to put in the chat what you think are the risks and rewards of investing, we can go ahead and move on with other content today. All right, I'm going to hand it over to Anne to talk about some of the risks of investing specifically, and I'll see if I can troubleshoot the Padlet situation. Maybe we can revisit it at the end of the webinar.
All right. So last time, 2 weeks ago, we talked a little bit about how to get started with investing. So once you've decided that you are ready to invest, then the first step you need to consider are your goals, and the timeline for each goal. So are you investing for retirement? Are you investing for college savings? Are you investing for general wealth building? Or, are you intending to purchase a home in a certain period of time? Once you think about each of those things, then you will know what types of investments that you're willing to take on and how much risk you're willing to take on for each of those different types of investments. So all investments have risk. It's just the way it is. It's not a game. It is not cash. So be aware that when you're investing, that you don't let it turn into something like a game, as far as like an investing app that gives you confetti every time you make an investment, or sad faces every time you one of your investments goes down in price. It's not a game. This is your future that you're dealing with. So take it seriously. Be aware of anything that is encouraging you to potentially invest more than you want to invest, or to invest in products where you could lose more money than you actually invested. Don't think of it as something that is a short-term must do this day. The investment goes up, sell. If the investment goes down, et cetera. What you should focus on is long-term investing for those goals that you set. Another thing to make sure that you do, take care of your needs first. I think we talked about this quite a bit last time. Don't use money that you need right now, and that you can't afford to lose. Treat it as something that, again, is for the future, not your immediate needs. So how do you determine investing risks? Different investments have different types of risks, but they also impact the type of return you can get. So generally, the greater the return, the greater the risk. So if you can look at the graphic here, you can see in the low risk, low return category, we have bank accounts, cash, money market accounts, or certificates of deposit. All of those are not risky, but they're not going to get you much of a return. Then you start moving up the arrow, and you'll see in the middle, we have bonds, and these could be US government bonds, treasury bonds. These could be municipal bonds from different states or townships, corporate bonds, or something like a mutual fund that invests completely in bonds. There's more risk, but you will get more of a return than you would with cash. But still, the returns are moderate. If you want higher returns, especially for your long-term goals, then individual stocks, mutual funds, or ETFs that invest in stocks, those are going to be higher risk, but they're also going to be where you can get a higher return. And you need to set your own expectations for what it is that you're willing to risk. And I think we're putting in the chat some different tools that you can use to explore your own personal risk tolerance. In general, for a longer term goal, you're probably willing to take on more risk in order to get a higher return. For short-term goals, you're buying a house in 6 months, then you probably want the money someplace where it's in a much lower risk, lower return space. So what stands out to everyone the most when you look at this chart? If you want to put something in the chat, you're welcome to do so. I think you can see, though, lots of ups and downs, a lot of volatility. The most significant downs that you can see represent some of the biggest stock market events in the history of our country, including the 1929 stock market crash and the Great Depression. You can see the 2008 downturn in the market. But if you look in general at this chart, and this is, almost 100 years of large stock performance in the United States, you can see generally it's up. And historically, the long-term average rate of return for the S&P 500, the Standard & Poor's 500, that represents the 500 largest companies and securities in the country, that rate of return is about 8 to 10%. So if you have a long time horizon for your investments, you start early, and you're not going to need to access the money right away, then you can generally capture the historical averages of the market and ignore the volatility and daily fluctuations. But I think that's something that's important to underscore. The shorter your time horizon, the more that volatility becomes relevant. So say someone plans to retire in the next year, they're going to be impacted differently by ups and downs in the market than someone that plans to retire in 20 years. So the closer you get to your target date, something that is important to consider is whether you start shifting your asset allocations to reflect really how your risk tolerance changes. So instead of being all in stocks when you plan to retire in the next year, maybe that's time where you want to start moving to bonds or bond funds or cash and having a different allocation. Okay, let's move on. So how can your investments lose money? What could possibly go wrong? Sometimes it's simply there are several companies doing the same thing, and a company's competitors are doing better than that company is. For whatever reason, consumers decided we don't want to buy from company A, instead we want to buy from company B. Or maybe management in the company is just not doing a good job running the company. Or someone is defrauding the company. Whatever the reason might be, you may want to consider selling your investment when the market for that particular stock is down. And then vice versa, when the market is very high, when the stock is performing better than it's ever performed before, maybe you want to sell all or a portion to take your higher return. The one thing to keep in mind, don't forget taxes. So buying on margin, this means that you are borrowing money. to make investments. If you're doing that, you need to be aware that this is that it's not a sure thing. If the value of the security that you invest in falls, then you could get what is called a margin call. And it's basically you're required to pay what it was that you borrowed, regardless of whether you can sell the investment to get it. This is something that I think certain investment apps maybe give people access to when they don't necessarily know that they're accessing it. So be aware, you could always lose more when you're trading on margin than your actual initial investment. This is not something that's for everybody. Same thing with short selling. Short selling is generally you're selling a stock that you don't own, and you may be borrowing it for delivery. And I think that the general theory behind it is short sellers believe that the stock is going to go down in price. So they'll hedge against any volatility in the security. And if the price of the stock drops, then they can actually buy the stock at the lower price and you'll make a profit. However, if the price of the stock goes up, then you'll incur a loss. Short sales also can expose you to the possibility of nearly unlimited losses, because in theory, a stock could continue rising indefinitely. So be aware that you could, again, lose far more money than you invested or intended to invest in the first place. Short-term trading is something that we get questions on all the time. And there are people that want to time the market thinking like if you buy in and out in the same day, that you're going to be able to essentially beat the market. But be aware, the markets can be volatile. And if you're trading in stocks that are subject to a lot of pressure in a single day, you could lose quite a bit of your money at one time. Again, margins, options, short sales, all of those magnify the risks. There's also a risk that your broker-dealer may decide that they want to limit the number of transactions you can make. If you make, 20 transactions in a particular day, they may decide to limit that. So be aware. We're going to talk about fraud a little bit further on today, but manipulation especially occurs in stocks that are microcap penny stocks, and it can happen when you don't even know what's going on. You see one of the securities going up and down and you're trading on it, and you don't have all of the information. So just be aware. There was a Library of Congress study of investing behavior a few years ago, and what it showed was that active trading generally will result in underperforming the markets. And there are a few reasons for this. We're human. Investors tend to hold on to losing investments too long, and we tend to sell winning investments too soon. We also overreact. We follow trends. So on good or bad news, you can see a stock falling dramatically or rising dramatically, but then at some point, the markets are efficient, things will even out. So when you're moving money in and out of the stock market, you may be missing some of the best days when the market is going up, as well as some of the worst days. Instead, if you have a long-term, low-fee, diversified investment, and you buy and hold, in general, what the studies have shown is that you are going to capture more of the market's best days in any given period of time. Another thing to think about is if you're picking only a few stocks that you hope or think will become winners, you may not have a diversified portfolio that can better weather these ups and downs in the market. And if you're trading in the short term, be aware of fees. You might be charged a fee each time you buy or sell, which ultimately is going to reduce the amount of money that you have invested, and it will reduce your long-term performance. So we're talking about a lot of risks. Couple of other risks that you should be aware of. There are always geographic risks, especially if you're investing in non-diversified funds. Say you're investing in a particular country's fund, or a particular commodity that is only developed in a particular area. Be aware, wars, anything, economic risks in a particular country, all of that could impact what your investment will make. Economic risks, there's always the chance of a recession. There's a chance that the economy could slow. And same thing, if you're investing in the stock of an individual business, be aware that there could be something with that one business that causes its security to go down, whereas the market as a whole is up. So things to think about when you are making investment decisions. There are lots of ways to participate in the stock market without attempting to pick individual stocks or individual stock winners. There are diversified portfolios that could be available to you in your workplace 401k, or in diversified mutual funds, or in diversified ETFs or exchange traded funds. And if you stick with them through the markets, you will weather the ups and downs for the long haul. And I think I'll turn it over to Andrea now.
Thank you so much, Anne. Anne did a really great job of highlighting some of the risks as well as the rewards of investing so far. If you are familiar with meme stocks, this is a type of phenomena influenced by social media. This basically refers to shares of a company that have gained popularity due to online and social platforms. We spoke more about meme stocks in one of our previous webinars called Memes and Money, which you can watch on YouTube if you're interested in learning more. So this particular phenomena is where fear of missing out, or FOMO, may gain a lot of traction in motivating people to invest, potentially in risky or even fraudulent types of stocks. So just keep that in mind when it comes to meme stocks. It has also gotten people interested in general in investing, and you might be here because you learned about a meme stock, and that's okay. We just want to keep you aware of some of the hype around investing so that you can avoid some of the risks. All right, so let's talk about investment strategies. Earlier, Anne mentioned that we were going to add some tools about risk tolerance. So there was a group of a couple financial planning faculty members at different institutions that created this risk tolerance quiz that you can participate in. And risk tolerance is something that we've talked about a lot in the past as well, but it varies from person to person and even across our lifespan. So for example, you might be less risk averse when you're younger, and then more risk averse as you get older or closer to the target date or a retirement date that Anne mentioned earlier as well. There is research that shows that younger adults and men tend to be more risky when it comes to investing, but that is just a trend and it may not describe your specific situation. This quiz is from University of Missouri, and it can help you identify what your own risk tolerance is if you haven't thought about it before. And you shouldn't use this as a guide, but rather something to inform how you approach investing or how to talk about your goals and tendencies with a financial professional. So this can be really helpful when you're thinking about your goals and what you're willing to risk, right? We were talking about don't risk things that you need, the funds that you need to live on. But this can help you in kind of understanding and navigating your own risk tolerance throughout a long-term investing strategy. Another strategy to consider is automating your savings. So most of us don't think anything of automating payments with our monthly subscriptions or streaming services or sometimes utilities. But we can apply the same concept to saving and investing. And it helps to do your saving and investing automatically because you set it and forget it. You can set it up either with your financial institution to have the money sent directly to a savings or investment account, like a mutual fund account, or to do regular investing through IRA. And this basically creates a habit of saving and allows the power of compounding to work for you over time. So if you are automating your investment of $75 a month, you could have over $5,000 after 5 years, over $12,000 after 10 years, and over $36,000 after 20 years. This example assumes a 7% average annual return. And of course, the stock market returns can vary greatly from year to year. So that's something to keep in mind. It's not going to be consistent, but this is an average over time. When you're investing in stocks or mutual funds with stocks, a diversified portfolio would have stocks from a variety of business types. So, in different sectors of the market, you wouldn't want to invest in only one sector. For example, all of your stock investments in aerospace, you wouldn't want that to occur because if for some reason the market value of stocks in that sector, aerospace, were to go down, your portfolio would be significantly impacted. So it's really important to invest in more than one company or industry, that diversification there. Small investors can diversify by buying mutual funds or ETFs that automates the diversification process. This also lessens the impact of any one investment, and it reduces business risk and market risk. So for example, at one time, there were a whole lot of companies that made typewriters. So if we only invested in typewriter companies, it's not very diversified. And it certainly, at this point in time, with reflection, does not sound like a good long-term investment. Typewriter companies are not very prominent now. So people also look to diversify their investments across asset classes. This is often called asset allocation. For example, they might put some of their assets in stocks, some in bonds, maybe some in real estate, some maybe in cash. You might keep some stuff liquid. And this also minimizes risk against market swings and allows for changing a portfolio's volatility risk. So these are helpful strategies when it comes to reducing the risks of investing. Another thing to think about is dollar cost averaging. So this type of investing strategy allows you to invest the same dollar amount on a regular basis, potentially every month, over extended period of time. So you will end up potentially buying more shares when prices are down, but fewer shares when prices are up. So at the end of, let's say, with this table that we have, we are going to invest in January, February, and March, the same $100 each month. And the price per share of what we're buying fluctuates during that time. So in January, it's $25 per share. So we get 4 shares in January. It's $33 per share in February. So we end up with about 3 shares in February. And the cost per share goes down to $20 in March, and we end up buying 5 shares. So that's a total of 12 shares that we have, and we spent an average of $26 per share over that 3-month period. So this helps us reduce some of the market and exchange rate risk that might be prevalent with investing risks, obviously. But this is another strategy that you can implement, is dollar cost averaging. Another thing that can really help you maximize your longer term returns with investing is monitoring fees. So fees can eat up investment returns over time, especially a longer period of time. So assuming two investments have the same rate of return, like 7%. We've used that in several examples, both this webinar and our previous webinar a couple weeks ago. The one with the lower fees will grow faster. Another thing to remember is that actively managed funds typically have higher fees than passively managed funds, like index funds or exchange traded funds that are more passively managed. So, when it comes to monitoring fees, you want to compare the fees when you initially choose your investments. FINRA has this fund analyzer tool that helps you compare fees over multiple different mutual funds and exchange traded funds. So you might check that out if you are interested in comparing some fees. Just to illustrate the impact, the long-term impact that fees can have on your returns. Is that you really need to research and think about them before committing to an investment. Because, for example, let's look at the impact of different fees on $100,000 portfolio over 20-year period. So what you earn after 20 years is shown on this chart. There's a blue line that shows a quarter point annual fee. The red line in the middle shows a half point fee, and the green line on the bottom shows a full point fee. So you can see that it's a relatively small fee difference at the beginning that adds up to tens of thousands of dollars over that 20-year period. That's because compounding interest makes a big difference in how much your money will grow, and the percentage of that fee will matter when it comes to long-term growth and returns. All right, so a few things to avoid when it comes to investing, and we'll probably touch on this multiple times throughout this particular webinar, is we want to avoid trends. For example, meme stocks, which I mentioned earlier. You want to be careful with investing in margins or options or short sales. Short-term trading, like we mentioned with Anne mentioned earlier, the study that was done. Investing in short-term trading, bubbles or manias can be difficult for long-term investing gains. Momentum investing and noise trading can also limit your investing returns or be risky. And you want to be aware of your own emotions when it comes to investing motivation. So that fear of missing out can be really difficult to overcome when it's one of the things motivating you to invest. So you want to be aware of market volatility, and you can learn more about FOMO and investment scams, and even being aware of your own investing motivations on HowieTrade. It's a educational tool that investor.gov has, and you can learn a little bit more about how to identify some of these risky things to be aware of. All right, so some other things to remember while you're investing. Compound returns matter. I think we've illustrated that with a few of the longer term graphs that we've shown. You want to diversify your stock portfolio as well as your asset allocation. Look for fees that are low, because keeping costs low will help you with keeping your long-term gains. And when you invest regularly using things like dollar cost averaging, it can help lower your overall costs when investing. And remember, if it seems too good to be true, it probably is. So just be aware of those things. Those are some red flags to keep in mind. And I'm going to hand it back over to Anne to talk about other ways of protecting your assets from fraud.
This is a topic that is near and dear to my heart, teaching people how to protect themselves so that they're not defrauded, and so that hopefully their names never come across my desk. The biggest thing that you can do when making an investment is to keep your eyes out for any red flags that something could be potentially a fraud. And really, the red flags are hopefully the types of things that you'll be able to recognize. First of all, read any documentation that you are given. Make sure that you aren't giving someone free license to go on vacations and buy themselves a car and a boat and a house and all these things with your money. So read the documentation that you get. If something sounds too good to be true, it probably is. So if someone is promising you a guaranteed return that will beat the stock market, not likely. If they're telling you that they can, they'll make not just the 8% that the stock market will return in a year, but they'll give you 8% per month. Ask them how they're going to do that, why they're able to beat the stock market, because it's probably not real. Same thing if they tell you that it is a riskless investment or there's absolutely no risk whatsoever. As you can see from the earlier slides, all investments have risk, and someone telling you that they have none is probably lying to you. Another thing that fraudsters try to do is they really try to give you a very, very limited time frame. Tell you that the investment's going away. You have to make the decision right now on the spot. And they do that because they don't want you to think about it. Because if you thought about it, you would realize this is too good to be true. This isn't something real. They don't want you to ask other people what they think about it. They don't want you to go home and look at other alternatives. So if anybody's pressuring you to buy right now, walk away, because it's probably not something that you want to be involved in. Any real investment shouldn't have any pressure associated with it. And you should be able to think about it and make a decision based on what is best for you, not what's best for someone else. And then same thing that goes along with reading the documentation. If there isn't any documentation, be very skeptical. Investments should include an offering document, a prospectus, anything that's not just an investment in the stock market, that's an investment in, say, a real estate venture or anything like that. They need to give you documentation showing you how your money is going to be used, what fees they're going to be charging, and supporting their claims. And in addition, they should be willing to answer your questions. And if they aren't willing to give you any documents and they aren't willing to give you proof and answer your questions, walk away. So there are a lot of different types of frauds and scams, a lot of different names that they go by. The things that you should be aware of, and I'm not going to go through all of these because we could be here the rest of the day if I did, but whatever they call it, it still is a fraud, and it has certain hallmarks of the same thing. It means that you're giving money over to someone, they tell you they're going to use it in one way, and instead they use it for something else. For example, with microcap fraud, they are using very, very thinly traded stocks. These are sometimes called penny stocks, and many of them actually trade for a fraction of a penny. And what happens is fraudsters, because they're so cheap, fraudsters can get an awful lot of them, and they will then pump them up. Called a pump and dump scheme. It could be called a scalping scheme. There are all sorts of different names for it, but essentially what they're doing is they're flooding the market with information to get people to buy, because then they can dump their own shares on the market. They make a lot of money, then the price falls, and you're left holding a bunch of worthless securities. Promissory note schemes are always seem to pop up over and over again. And essentially someone's giving you a note that says, we're going to give you interest if you give us your money now. And this is a guaranteed interest rate usually. And instead they're just taking your money and they're using it for their own purposes. Ponzi schemes, it's a very old scheme. And in general, what someone is doing is they are offering you a significant guaranteed return. Usually they're very high returns, but sometimes they're even fairly modest returns, but they guarantee them. They tell you there's little or no risk. Or that, every month you will be assured of getting a specific percentage, a specific dollar amount in interest. Oftentimes they have a proprietary secret strategy that they can't share with you exactly how they're going to make money. Just know that we did make money. And what they're really doing is they're taking your money and using it to pay people who previously invested with them. And they'll keep bringing in new investors in order to keep paying interest to the old investors. But your principal, it's all gone. And at some point, it will fall apart and you'll be left holding the bag. Oftentimes, these are individuals who are unlicensed, unregistered. The investments themselves are unregistered. So it would be something that, for example, in a case we brought a few years ago, there was an individual who said that they had this proprietary trading strategy involving, and they always use complex words, arbitrage and other secret things that they developed in order to make lots of money, and they would guarantee you a return of 6% per month. Okay, 6%, that doesn't sound that high, but if you think about 6% per month is a lot more than 8% per year. And what they were doing is made a couple trades. They could show people that they had a brokerage account, but in reality, most of the money was going to fund clothing and condos and cars and a really nice lifestyle for the Ponzi operator. And at the end, when everything fell apart, there wasn't a whole lot of money left for investors. So just be very, very wary with unregistered sellers, unregistered investments, and secret strategies. Romance and relationship scams are another heartbreaking example. A lot of times this will be either you're reaching out to somebody or someone sends you a wrong number text or a social media message, and they develop a completely online relationship with you. Usually they'll tell you, they can't meet for some reason, or they'll need money for a particular reason, a surgery, something along those lines. And it always is, send me money, send me some sort of cutting edge new investment that's untraceable. Send me gift cards, send me something, and I'll pay you back to you with interest. But they're not going to actually pay it back because it's a scam. I think, Andrea, you had a couple things you wanted to say also about romance scams.
Yeah, so something that's similar but not really considered a romance scam is something called economic abuse. This is a type of abuse that actually typically occurs with romantic relationships, but it could happen with family relationships or caregiver relationships. There's lots of instances where economic abuse can happen. It could be with someone that you're dating or cohabitating with, or have even been married to for several years. You may know this person really well. And so the economic abuse involves one partner controlling the other partner's access to economic resources. So this might include limiting their access to money, controlling their spending very closely, preventing them from working even, or taking over their investments or preventing them from making progress towards goals like retirement, which is often requires participation in employer-sponsored retirement plans or contributing to an individual retirement account. The abuser may take over all these economic resources, and that is called economic abuse. And it can be sometimes more difficult for people to get out of than identifying what a romance scam is. So we talked about this in one of our recent podcasts with the Illinois Department of Financial and Professional Regulation on money and relationships. So we put that in the chat if you want to learn more about just navigating the nuances of money and relationships and understanding where romance scam issues pop up, as well as how to identify symptoms of economic abuse. All right, I'll hand it back over to you, and to talk about persuasion tactics.
Thanks, Andrea. So really, how do you figure out if someone is scamming you? I mean, one of the easiest ways to avoid scams is to invest in the stock market through a broker dealer that's registered with the SEC and FINRA. But if you want to make other investments, be aware. One of the things that fraudsters will do is promise you wealth. If you make this investment, you're going to be wealthy beyond your wildest dreams. That generally doesn't happen with a legitimate investment. That's not long-term investing, building wealth over time, as we discussed. Instead, anything that is a get-rich-quick scheme is likely a scheme. Scarcity is another thing that often pops up, where a fraudster will tell you, if you invest now, I've only got 2 more people that could invest with me, and then this deal is going to close. So I'm giving this to you because, I really like you. You seem like a really nice person. But they create a false sense of urgency by saying that there is only a very limited opportunity, and they're offering it to just you. Sometimes you see this in lots of different types of scams. Someone offers to do something very small. They'll gift you something, a lunch, a dinner, anything, coffee. And in return, you'll turn your money over to them. Be wary of that. Anybody promising you something for nothing, be very skeptical. Many times we've seen that they will try to show you that other really smart people have already invested with them, trying to make you feel like you're not smart if you wouldn't do the same thing, and trying to make you not ask questions because all of these other incredibly wealthy, smart people have already done this. Don't follow the crowd, ask questions. Make sure this is the right investment for you. Just because it was right for someone else, or even could be fake, but make sure this is the right thing for you to do with your money. And then the other thing that people will do is, they'll claim that they are affiliated with a reputable firm. We've seen it where sometimes they will make their firm name be 1 letter off from a household name, so you think you've heard of them. Or that they have special credentials behind their name, and so they're an expert. So why would you ever question them? Don't fall for that. Do your homework. And what really this all comes down to is they're trying to make you afraid. They want you to be afraid that you're going to run out of money. So you'll give your money over to them in the hopes that it will build you wealth much faster. That you're afraid that you're going to miss out on something, and therefore everybody else is smarter than you are because they're making money hand over fist and you're not. They want you to be afraid to ask questions because you don't want to appear unintelligent. Ask every question and make sure that you're satisfied with the answer before you make an investment. They'll also scare you that you're falling behind. Everybody else at this particular age has this much in retirement savings, and you'll feel bad because you don't yet have that much in retirement savings, and therefore you're falling behind. So you'll do something maybe riskier than you ordinarily would do. Don't fall for it. Fraudsters use, and it's not just AI, fraudsters use all sorts of different kinds of new and cutting edge technologies to get you to invest, whether it's, they say that they are actually themselves a company that is doing something in that cutting edge area. So, you want to get in on the ground floor and invest right now. Or they could use AI to clone voices, alter images, create a deep fake video that makes you think that they are legitimate when they're not. They can, you know, impersonate a family member or someone from the SEC, or other government officials in order to get you to turn over your information and your money. You know, they'll announce false press releases, making it look like a legitimate source has created all of this news around something cutting edge with their company, when in reality, it's just fake. So be aware. Protect yourself by asking questions. Ask every question and be satisfied with the answers. Understand what fees are coming out of your investment off the top, because nobody does anything for free. All investments have a fee of some kind. And if they tell you that it's a no fee investment, be ready to walk away. You have the right to understand what it is you're investing in and how they're going to make money from it. That is incredibly important. And if it sounds too good to be true, it probably is. Trust your instincts and walk away. Some questions that you should kind of keep in your back pocket to ask yourself and others, including any investment professional. Is this a good fit for my current goals? Is this something that's going to get me to what I am investing for, whether it's retirement, eventual home ownership, any of those things? See if this investment fits with your time horizon and the goals that you have. Make sure it matches, you know, that what your goal is realistic. Can I actually make enough money in this period of time to do what it is that I want to do with this particular investment? Make sure you're considering risk. Make sure that, you know, if you are investing at a regular pace, you can do that and meet your monthly expenses, but also modify it if needed. So there are a lot of tools on the SEC's public investor-focused website. It's called investor.gov. And go check it out. There is a wealth of knowledge there, but there are also a number of different types of calculators that will help you decide what your time horizons are, what your goals should be, and play with it. Something really important to be aware of anytime that you are going to go with an investment firm or an investment professional, check them out. You can look them up on investor.gov, whether they're an investment advisor or a broker-dealer. There are links there. You can check and make sure that they are licensed, that the security is, or the firm is registered. You can see their employment history. Something really important to look at is whether they have gone from firm to firm to firm to firm every year. And maybe that is a red flag. It's at least a question you should ask. Why is that they don't stay in one place for very long? You can also see important disclosures about the individuals and firms that you're investing, including whether they have any disciplinary history, whether the SEC has sued them previously, and what it is that they were accused of doing. Those are all important things that you can do. And it's free, it's easy. It's not something that you have to pay for as a service. It is available to the investing public, and investor.gov is an SEC website. So it's not going to tell you what to invest in, but it's going to give you the information that you can use for yourself, and help you see if there are any red flags. So here are a couple of examples of things to be aware of when you check out an individual or an investment. And if you look at the first box, it is the broker check profile for Jordan Belfort, which many of you may have heard the name before. He was the Wolf of Wall Street. There are books and movies about him. And if you look, you can see says he was previously registered. That means no longer registered, no longer supposed to be selling you an investment. And it says that he has been barred, and it says he's been barred from making, from acting as a broker or investment advisor or associating with any firms. that provide investment advice to the public. So this is a really easy way. You just pop into investor.gov. It will take you directly to BrokerCheck to look him up. And if you look up someone and you see that type of information, walk away. Same thing in the second box. This is an investment in a microcap stock. And if you see a skull and crossbones, walk away. That means that this is a security that is no longer eligible for trading, and buyer beware. Right.
I think I get to talk about learn more about investing. I did want to mention because Anne, you talked about going to investor.gov to get to these resources. BrokerCheck is actually a FINRA tool. So it might say FINRA.org when you go to the BrokerCheck, but FINRA is a regulatory entity for the investment industry. So I just wanted to clarify if you're like, this seems weird. It is a regulatory entity that is sharing the BrokerCheck information. I just wanted to highlight that since we didn't talk about it. But sorry, go ahead.
No, thank you. Thank you for mentioning that. And just, you can link it to it all through investor.gov. We've got links to a lot of other sources on there, but they may take you to, I think there's some other calculators as well that will lead you to FINRA's website. And that's okay. That's legitimate.
Yeah, FINRA's another really good tool to use. But investor.gov is obviously where you can learn a lot more about investing, like tips to avoid fraud. There's the compound interest calculator that we use for a lot of our examples in investing education. There's also a lot of unbiased content for investor research, and you can also look at publications around investor alerts. Someone asked in the chat about how you can monitor these types of scams or fraud. Sometimes there'll be investor alerts through investor.gov. You can actually sign up for investor alerts. I get them emailed to me, I think weekly. So you can use that through investor.gov. We have other webinars related to investing. Obviously, this one and the one we did a couple weeks ago, and we did one in November on kind of asset management over the lifespan that touched on specific elements of investing management. And then we have podcasts on relevant topics to investing and financial management in general. And there's also simulations that you can participate in, like the stock market game or Market Watch's virtual stock exchange, so that you can kind of get the idea of investing without jumping on into the deep end where you could potentially lose money. So those are some tools that you can use to learn more about investing, maybe enhance your confidence around investing before you actually get started if you would like, or as you continue to grow your investment portfolio or navigate different challenges that you're dealing with. So in summary, we want to highlight that all investments have risk, and you want to know your risk tolerance so you can navigate what that means. You want to avoid fads, fraud, and FOMO. So not just being aware of what's out there. We know that financial knowledge can help you identify risky investments, but you also need to be aware of yourself. That's why we talk about risk tolerance as something to be aware of. But like Anne said, a lot of investment fraud preys on your emotions, your fears. So being self-aware can help you avoid making risking decisions. And then you want to evaluate your investment situation and financial situation regularly and modify it based on whether you have shifts in your goals or shifts in your resources to commit to investing, because there's going to be fluctuations throughout your life in what your economic resources are, what your priorities are. Emergencies can pop up at any time that might have implications for some of your investing practices on a monthly basis or kind of a yearly basis. So you might have to make adjustments throughout your life, and that's okay too. Our next webinar is on student loan management. So if you have student loans, you may want to sign up for that webinar. It's on March 6th. It's a Thursday at noon as well. We also have a post-webinar survey that if you can fill out, it will help us figure out how good we did on this webinar and how to plan for future webinars. You can also watch all of our previous webinars on YouTube. It is IL Student Money, the Student Money Management Center for University of Illinois has a channel on YouTube where we post all of our webinars. We also have a lot of collaborators on the Get Savvy series, so I want to recognize all of their hard work for the whole series, not just today's investing webinar with the SEC. And if there were any questions, we can answer them in the chat. If you don't have any questions, feel free to log off. We're not going to keep you. You might be hungry, you might need to get to class, but we appreciate you joining us today.